All right, next section, common misconceptions. So as I said, Dave Ramsey, a lot of people will say whole life insurance is a ripoff. And I think this is the classic example where your long lost high school classmate or your buddy from college, the last time you saw him, you guys were drinking beers into the wee hours of the morning. 5, 10, maybe even 20 years later, you have a chance meeting with this person. They call you up out of the blue. They're working for a financial planning company and they pitch you on this idea of getting a whole life insurance or any kind of insurance product. You trust them, right? And they bamboozle you into doing the policy, but they set it up the wrong way and very different from what we're talking about here today. So it's all depends on how you design this thing. And I explain things differently. Tyler's going to explain it a little bit differently, but I think it took me personally like 3 or 4 times of people explaining it to in different ways to finally understand how this is different. I knew that the wealthy did this, but I didn't know exactly how they did. Hopefully something we say here will resonate with one of you guys. But ultimately, when you learn this types of alternative investing techniques, it's always good to meet up with other people who are actually doing the same thing and kind of talk it out with them.
Yeah, and traditional whole life is usually illiquid for a good portion of it. You don't break even probably till 15 or 16 years. So it gets a bad rap along with even policies or the product within the same company. It's really the design that makes it perform to meet your goals. So a poorly designed one will cost you money, and the product is insurance, which has an expense to it. Just like how car insurance, it's an expense. It's not an asset, but it serves a purpose. There's a lot of people out there, and there are examples where insurance is designed poorly, and that's a fire to cause a lot of the Ramsey to knock whole life.
Yeah. So again, going back to our personality types, this is where me, the venture, I realized what people were doing with this, how they used it in their large investing strategy. And then I realized that there was a lot of fees I was paying for this stuff. So I asked Tyler, hey man, can you look at this? This is like years ago. And of course, it took him a lot longer than I thought. And then I guess I didn't realize that there's so much to this in the design standpoint. I thought it was just a box off the shelf. But in reality, you're buying this thing, but you can configure it multiple ways. And there's 3 big sliders the way you can configure it. If you don't hit all these sliders the right way, this is not the way that we're doing it. So I don't know. But if there's 3 different ways to do it, is it 9 permutations and commutations? I guess there's only one of those 9 that work. Do you want to explain this one, Tyler? I think I took a stab at it, but it's always good to hear it from a different angle too.
Oh, just the difference. Yeah, whole life has a cash value component to it. It costs a lot. The premiums are higher, but it is building some cash value. Term is exactly like that car insurance example where it's use or lose. So you're paying a premium. It has its purpose as far as protecting or having a death benefit for very little premium, but there's no cash value aspect to that. And the cash value part of the insurance product is what we're using as the private vault or that savings account. There are hybrid policies, and we actually use 1-year term life blended with whole life. That's to allow us to buy the death benefit very cheaply for a low expense. But we cut it off after a certain time to cut the drag off of your policy and not have those expenses go for the whole life.
So term life is for a different reason. Right? You get term life in case you die, so you can have your survivors get a chunk of money. That is the purpose of term life. Whole life, yes, it also does that. But to me, the way I am, I don't want to spend money on something I'm not trying to do or something of the utility I'm not going to get for. So I try and separate the two. When I ask people, what are you trying to do? Why are we here today? We're trying to use infinite banking to stuff cash to invest and higher invest use thing. We're not here. I think all of us need some term life, which we get a lot through our jobs. To me, you separate the two. You get the product of what you're trying to go after. And then this is just another example of my wife. So like somebody did take her out to lunch and she probably didn't get a free lunch out of it, but somebody she knew set her up with one of these policies. And when I came around years later, I was like, why the heck did you do that? And she said, like, I needed a big payout in case I died, so my parents wouldn't be left with the condo. And I got really upset. And I was like, that doesn't make any sense to me. Let's stop and think about it. If you died, your parents or your survivors would just sell your condo. It's not like the bank's going to come and take it away like that. There's equity in there. And even better, if there's no equity in there and you died and you're negative equity, how you can just walk away from that type of thing. But she got sold on this thing, and most people aren't aware of these type of financial products or the reason why the heck you're getting it in the first place. For somebody like that, and you're single, to me, I don't think you really need any term life, but most people here are married, and I would recommend some term life. Maybe, I don't know, what do you think, Tyler? Maybe like 1 million or 5 million for the average people here.
Yeah, and it matters because some of the policies, the way we're designing it does have that term. So the death benefit is relatively high early on. There's a traditional way of calculating how much insurance you need. It's your earning power for your life, or looking at yourself as an ATM machine. If you were to die, your beneficiaries would lose that earning. So that's the amount of death benefit you would need. And if you don't have that covered, then that's how I would, or typical people calculate how much death benefit you need for the purposes of your beneficiaries. But yeah, I would say it's very on an individual basis. There's not a one size fits all from my perspective, as far as how much or size of policies.
Yeah, everybody's different, but you pay for what you get, right, guys? If you want a $10 million death payout from term life, it's going to cost you more. And there's a lot better things to be putting money to your insurance premiums, right? It's no different than over-insuring your car, that type of stuff. Where I think a whole life, the reason why there is a little bit of an insurance component, the way we do it, is exactly to get those tax benefits, because there's a minimum amount of life insurance you have to get when you do these things, so we get that good tax treatment. And I think what most people will find when they grasp this, when it finally clicks, they grasp this infinite banking strategy, they're going to load up on a boatload. When I first started to do this, I was like $50,000 a year for 6 years, had built up at least $250,000 of cash value in the policy over the years. But nowadays, I'm looking to maybe 5x that at least. And I think when people, this is what the wealthy do, they just load up on these policies. When you're loading it up with that large of a cash value drop, inherently you're going to have a lot of death payout, so that you don't really need term life. I think if I die, that might be like a $10 million payout. It's life-changing. And that's another term I like to use a lot, is what is life-changing money to you guys? For a lot of people, and this is off topic a little bit, what kind of money do you want your survivors to have? I would think at least $1 million, because $1 million is really nothing these days, but maybe anywhere from $2 to $10 million, I think, where most people stay. And when you get a normal size whole life policy, most people in our group, accredited investors, they're usually loading this thing up with $50,000 to $100,000 a year. And when you get that large size of a policy, you're going to have that. I mean, what is it, Ty, like $1 to $4 million death payout for that kind of size of a policy? You have off the top of your head?
Yeah, sorry, for what premium size?
Let's say a guy does $100,000 a year for 6 years. What is the death pay?
For a 40-year-old male would be probably about close to 4 mil, the death benefit for $100,000 a year policy.
Yeah, that's just one data point, but it's pretty linear relationship. Let me take this one. I think I talked about it a little.
Yeah, so whole life versus whole life, it's a contract for your whole life. The fees are set. A lot of the terms of the policies are set. Index, it does have potential greater returns correlated to usually the S&P 500 and its index. So a lot of times it matters when your policy anniversary date is. So it goes from, say, October 2nd. So look at October 2nd of 2021 and then October 2nd of 2022. And the difference is, the gain is what in the stock market and S&P would be what you would receive minus some fees. So it varies. It varies even person to person based on, if your anniversary date is October 2nd, someone else's one is October 15th, they may get a different return, even though it's just 2 weeks apart, because of how the index feature works. Along with that, expenses can fluctuate and go up, and it's not set for your whole life. So yes, there are higher returns, but there is also higher risk that the expenses will grow also. And the index, a lot of the selling point also is that you can never lose money in the sense that you'll never get a negative return. However, the policy can lose value in the sense that expenses start eating away at that as it grows. But the index has a floor. So say this S&P dropped 10% this in your index, it usually has a floor of either 2% or 0%. Instead of that stock market chart where it drops, it'll just stay level and then grow. But there's also a ceiling. So if the S&P went up 20%, you're usually capped at like around 8, 7, 9%, and then you'd have to subtract maybe some of the fees. So it is a lot more attractive versus the dividend rates of 5.5 to 6%.
Yeah, but like the dividend rates are higher, but you guys is missing the point, right? The whole point is you put the money in here as a short-term thing, and then you take it right back out and you invest it, which you don't have that flexibility with the IUL. And when is one more appropriate than the other? The whole life is, to me, the growth strategy, right? That up until you hit this point that I call critical mass, is this big chunk of money. For some of you guys, it's $2 million net worth. For other people, it's somewhere between $10 million net worth. You're trying to accelerate up to and grow up to that point, and you're going to need this infinite banking music whole life to overfund the policy, take it right back out as a loan to put to your investments. Not until you've this or getting well on the way to this freedom point, escape velocity, zero G, whatever you want to call it, or what I call it more end game. That's, to me, when you start to use these other IULs. And we'll do another probably cram school on this in the future. But most people here are still trying to grow their wealth. And that is why we choose the whole life. If you want a part of your portfolio that's very low risk, lower return, and you want to get it, yeah, sure, you can do it. We can talk offline. You can talk to Tyler about doing one of these other things. But like the whole thing about the whole life is like, the cool thing is there's a little trick is like taking the money back out and investing it, and overall, you get a bigger return instead of just myopically just looking at, let's have a higher dividend than whole life. Yes, if you look at it myopically, you are correct. But the whole point here is putting the money in the whole life and taking it right back out and putting it into a deal on the side. We had a question here from Justin. Why not buy term and invest the difference? No, you're exactly right. If you don't want to do any of it, but that's for a different purpose, right? You're trying to insure yourself with a death payout. We're not doing this, or at least I'm not doing this for death payout. I'm not sitting on infinite banking policy for death payout. It's a store of cash that grows tax-free that I can invest it. But if you're looking for death payout, I would suggest appropriate amount of term life for that.
Yeah, and there's some questions on here. We'll get to them. Some of them we're answering privately, but some of them there's probably benefit answering it as we discuss it on those sections. We'll get to all the questions.
Yeah, again, if you guys want to hold questions to the very end, unless it really pertains to what we're talking about. So this isn't, some people like to really understand the nitty gritty. I'll let Tyler explain like different places that you can go to, different insurance companies. But for those of you guys want to take a nap right now for the next 5 minutes, so as we go through this, like just use the top rated best. I don't know how they rate them, like credit based or the Moody's or whatever, the top rated insurance companies, because they have the best balance sheets. Simple passive cash flow.
And this one specifically about the stock insurance companies versus mutual. The biggest difference is, as for the policies that we write are with mutual insurance companies. The difference is that mutual insurance companies, as a policyholder, you are part owner of that company. There's no shareholders. It's only policyholders. With the stock insurance company, it's owned by stockholders. So the company itself has two interests that they have to appeal to: the policyholders along with stockholders. So that's where it gets a little more hazy, maybe not as transparent. There is a question on here about the dividends being paid are because you're overpaying premiums. And that is partly true, right? But you're overpaying the premiums because these companies they have to have a reserve. They have to pay out death benefits. The dividends are basically the company's profits that they have, and some of that is overpayment of premiums. Also, it's their investments and other things, policy loan interest. But as the policyholder and mutual company, you benefit from those dividends. It's almost no different than if I was a stockholder in Costco and you're overpaying for that toilet paper, and the dividends you get will be the profit. So it's for that company, and part of that company's profits would be you overpaying for that product or their profit. So it does sound like, yeah, you're just getting your money back, but it's no different than paying a profit for a product, any other product that you buy from any other company.
Yeah, and the insurance companies that we'll use are probably heard of them a lot because they've been around since the beginning of time. Guardian and what is the not the good? There's two mutuals, right? One of them is we try Northwest Mutual. We try and stay away from because they just don't. You can't do this kind of strategy as effectively.
Typically, the four large, proven mutual insurance companies are New York Life, Northwestern, Mass Mutual, and Guardian. And Penn is coming up there. However, their track record may not be as strong. But yeah, and the dividends for a lot of those companies, Guardian especially has been paying for over 150. That's through the Great Depression, through the wars, through stock market corrections, all of that. They still continue to pay dividends consistently.
Yeah, and that's we talked about that earlier, right? You don't want to just go to some random life insurance company that hey, I don't have to do a physical on this one. So that doesn't sound good to me if I'm a policyholder and I got all these other random people in here that haven't done physicals, right? To me, I do it. You go to one of the top companies because they have the best balance sheet, best track record. I think I got a policy too with the Veritas. The way we do it, we're ubiquitous. You just go to we just pick the best one for the individual person. And this is where I didn't realize, I just told Tyler, hey, go get me one from this guy. But even within each individual company, they have different products. And then this is where I realized, whoa, you need to study this all the time, Tyler. Like this will be your thing. Like every company's individual products change and cycle through. Any insight on that one, Tyler?
Yeah, and there is this big law change that happened early or late last calendar year that has to be in effect this year. So that's a great example of all these new products are coming out, and how you design it is changing. Some of the performances are changing, and it is a full-time job of watching and catching up on things and changing it, and you can tweak it. And also within a product that's good for someone may not be good for another one. There's all within the company's little bit different quirks of flexibility, whether it's the funding amount per year or the funding duration, their online portals or the use of the portals and access to the funds and the ease of that. There's some fluctuations company to company. It definitely isn't a one size fits all.
Right. And just case in point with that, like I think with Guardian, they have this component where right now, at this point in time, this probably will change in the future. Who knows? For people like entrepreneurs, right? You guys have very fluctuations in your income levels. Some years you might make a ton. Some years you might be a bearish year for you. That's how it is as a small business owner. Guardian has this little like kind of component where you don't have to make your payments every single year. There's a little bit of flexibility there. And that's why when you guys book your onboarding calls with Tyler, that's why it takes so long. That's why it's a long chat. It's not just a quick 15-minute thing. We want to understand your guys' story too, because we know what the policies are, or the options of each company. We want to make sure it's tailored just for you instead of just stuffing you in a Penn Mutual one, because that's the only one we're licensed in. We look at a bunch of companies, and within each of those companies, different products. And that's something I've learned after a while, like these insurance products, once you get the right ones or commodities, and after that point, it's just how much your sales guy wants to charge you in commissions. It's no different than getting a home, right? Where your lender just charges you X amount of origination fees, and that's the profit. And some guys will charge you a lot for some strange reason. Some guys will charge you less. What we try and do here is we try and vary the commissions as low as we can to make it more advantageous for you guys, because you guys aren't getting these ticky tack $5,000, $10,000, $20,000 a year banking policies, most of you guys are getting 50, 100,000, maybe $250,000 every year of this stuff. So we want you guys to come back, and as your life changes, your situation changes, and the products change. We like to know who you guys are, but there's a reason behind it. After all, Tyler and I are both engineers. We're not the most we don't really like to chit chat too much. Want to get in, get the best policy for you guys and get out, but we need to get to know you guys a little bit to fit you in the right.
I'll take so yeah. This is often a popular question about, hey, should I pull a policy on my child? Purely for the IBC purposes, my normal recommendation is you want to maximize the policies on yourself. So there's limits because it is an insurance product. You can if there's a limit based on your annual earning along with your age. So that's the amount. There's a calculation. If you're in your 30s, that limit of death benefit may be about 30 times that your annual income. As you get older, it goes down to 25 times, and maybe when you're 50 or so, it might be as little as 20 times, and then 60 might be 10 times. So that's usually the total amount of death benefit one can have across all policies, companies. So I would say first, as a parent, you'd want to maximize your ability to buy insurance on yourself. The reason for that is you have earning power. The premiums would be a lot less or more beneficial that you can maximize the cash dump or the PUA portion of it. With a child, not especially a minor child, not having an earned income, the amount of death benefit you can get on a child is limited to basically 50% of the parent's death benefit. So the parent needs to have a policy in place first in order to buy death benefit on a child. And then based on that limited amount of death benefit, because they're so young, the premium will be actually very cheap, which sounds good. However, you're not able to max fund it. So it'll be, instead of being able to stuff in 50 or 100,000 a year, you're probably limited to maybe 7,000 a year. And so you're not able to really grow your cash value as fast as a policy on yourself. Policy on a child does have its benefits in other ways, but purely for the IBC portion, it's not as efficient as having a policy on a working adult.
We like the creative thinking, guys. This is what's fun about this stuff. You guys, different ways to use it. But yeah, if you want the simple passive cash flow cliff note, if you got a couple, most people do is they get it on the female because they're just a little bit cheaper. I don't know why. Maybe guys are a little bit more reckless. They tend to die quicker. They're a little bit cheaper and maybe just get it out of one of the two for now. And then when you fill up that policy, fill it up, maybe putting in $10 million of death payout or stuff it with $1 million, then you fill up the other person. But every situation is different. That's just giving you guys a real quick example to get it in your head for now. We had a good question here. Mark asks, we currently have a term life policy since we have young kids. We only wanted this until our kids are 18. If we started to do infinite banking, we need to cancel the term life policy. So two different purposes here, right? If you want the term life in case you guys kick the bucket, your kids have a nice chunk of money. Going with the example of, let's just say you bought $2 million of term life because you want them to have a couple $1 million drop if you kick the bucket. Like Tyler said, if you're stuffing this whole life policy with 50, 100 grand per year, you're going to get that utility. So you could probably just drop your term life at that point.
Yeah, and I was actually typing, so you don't need, it's not going to be required to cancel it. It may make sense to, but just keep in mind that the death benefit of your term will count against the total death benefit that you can get in overall insurance. So if that's a limiting factor based on your earning power, then it may make sense to cancel it. But it's not, you don't have to.
Most of you guys will be loading up on larger policies anyways. You hit two birds with one stone already, that you could probably just drop your term. That's why we have the conversations, right? This is a little bit complicated. It's multifaceted. Tyler does this all day, so he can help you with that from that front. Another question that comes up a lot, and you guys can watch these videos later on for more details on this. I'm 40, 50, 60, 50 years old. Isn't it going to be more expensive for me? But if you remember from the start, we're not really configuring this for the death payout, right? We're minimizing that portion. Therefore, the pricing is not really dictated too much on your age. Yes, it's going to be a little more expensive, but at the end of the day, it's really kind of a minor wash.
Yeah, so the biggest impact you would see, if you're doing it, if you're a 60-year-old versus a 30-year-old, would be the amount of death benefit it buys. But again, since we're not focusing on the death benefit, the cash value portion, it'll still perform relatively the same. Instead of maybe breaking even at year 4, a 60-year-old may break even at year 5 or maybe 6. Matters on some of the design. But the biggest impact too is that you don't have the years past that for it to compound. So of course, when you look at a 30-year-old at age 85, the cash value versus someone starting their policy at 60 and then looking at the cash value at their age 85, it'll be a lot smaller along with the death benefit. But the cash value will perform the same way. So, there's cases where a 7-year-old can pull out a policy. Again, requires underwriting, so you need to meet some of the health requirements there. But even then, it can make sense for a 7-year-old to start pulling policies for the purposes of the cash value group.
Doesn't matter which life insurance agent I work with is in the same company. This is where I would recommend going with a broker that's licensed with multiple companies. So you're not just pigeonholed with one company, because different companies have different caveats and flexibilities. Stuff changes all the time. Just if you're going to a lending broker, you want a lending broker to be able to go to different banks to get a loan. I think the broker arrangement is just better in this world too. But ultimately, it's how much does that lending broker or that life insurance agent want to take in commissions? We play around with the life insurance splits and we make it the least it needs, which is not the best for commissions, that's for sure. It's best for what's the client, and especially for this purpose, we're trying to maximize that cash value in the policy so you guys can take that money and go invest it elsewhere.